Welcome to AnalyzeTheDeal.com. AnalyzeTheDeal.com is a section of GetRicherQuicker.net. What we're going to do in AnalyzeTheDeal.com is teach you how to analyze your real estate deals like the pros do, so that you can make better decisions, get a better return on your investment, get richer quicker. I'm going to keep each of these videos to under 10 minutes. I find that if they're more than 10 minutes, people start getting glassy-eyed, they lose interest. But you're able to watch these videos as often as you want, so you can always come back and refresh what we've gone over. Now, in this example, the name of the project is Elm Street. Federal tax rate 39.6%. Going in cap rate is 9.6. Purchase price is $8.7 million. Since it's residential property, it's depreciable over 27.5 years. Now, we're going to allocate 25% of that purchase cost to land. The rest, 75%, is going to go to buildings. The reason you have to make an allocation is land is not depreciable. Buildings are depreciable. So you have to come up with an allocation between building and land. Now, we're planning on owning this property for 5 years. The broker's commission will be about 5%. Other closing costs, $45,000. We're going to get a loan percentage of 80%, and the loan's going to be for 300 months, the interest rate 8%. Based upon our due diligence, we think our gross rent potential will be $1.275 million, and that we're going to be able to raise the rent by 3% per year. Vacancy and credit loss will be about 5% per year. Now, these are our operating expenses: utilities, property taxes, insurance. We expect operating expenses to increase by about 2% per year. Now, when you click Calculate, you come up with the calculations. Purchase price $8.715. Now, remember, we are allocating 25% to land. That's $2.8175 million. Building allocation, $6.62 million. Cost per unit, our loan amount at the 80% will be $7 million. Loan percentage, 80%. Equity that you need to come up with in this deal is $1.75 million. 30 months. The monthly payment will be $54,000. Now here we have our P&L, our income statement, our projected income statement. Like I said, we expect the rent in year one to be $1.275 million. Vacancy and credit loss, that's where people don't pay, or they happen to move out and you can't rent it for a period of time. That's 5%. Effective gross income, $1.211 million. Our utilities, net operating income is $836,000. So here we have year 1 through 6, and I'll explain why we use go up to 6 years. When you're doing a projection like this, you use 6 years as an estimate in order to calculate what you're going to sell it for. So we estimate, with the rent growing at 3% per year, by year 6, the rent will be $1.478 million. Net income will be $990,000. These are our expenses. Depreciation, like I mentioned, it's based upon the building depreciable allocation. The mortgage interest expense, which comes off the mortgage. Taxable income, $40,000. Cash available for debt service, $836,000. Debt service is $648,000. And again, we're going to go into detail. There'll be a separate module for what each of these items are, but I want to give you a general overview of what we're doing here. Again, this will help give you a better understanding. There's a writer, Robert Kiyosaki, that you may see on TV, and he has a book, Rich Dad, Poor Dad, and he sells that whole theory of Rich Dad, Poor Dad. His rich dad was a college professor. I believe he had a PhD from Stanford, taught at Stanford. Stanford's one of the top universities in the world. So he was a very, very bright guy. He ended up dying pretty broke. I forget the details of what happened, but he wasn't savvy business person. He wasn't a savvy investor. I think he ended up dying with very little or broke. He was the poor dad. The rich dad, which was Robert Kiyosaki's best friend's father, ended up being one of the wealthiest men in Hawaii. Now the story begins, Robert Kiyosaki's story begins back in the 50s, so it was some years ago. But Rich Dad, I don't know if he even had a high school diploma. He may have had a high school diploma, definitely not a college diploma. He got into real estate investing, and he started some other businesses. And he would take his profits and he would put them back into his businesses. He ended up dying a very wealthy man. Like I said, one of the richest men in Hawaii. So what we're teaching you to do here, and Robert Kiyosaki says that if you don't have a basic understanding of accounting, it's like opening a business in, say, Japan, and you don't speak Japanese, okay? Accounting is the language of business, and you need to have a basic understanding, and that's one of the things we're going to teach you here. I know everybody hates accounting. I deal with attorneys, and they have questions on, tax law and things, and I'll ask them a couple questions, and I've had them tell me, John, I don't even balance my own checkbook. But if you're going to be in business, you have to have a basic understanding of accounting, and that's what we're going to teach you here. Okay, so now this is your debt service. That's your mortgage payment every year. 12 mortgage payments of the $54,000. Okay, debt service. This is cash available for distribution. Again, your cash before tax cash flow. This would be your income taxes. Get rid of this stuff. Investment, pre-tax cash-on-cash return, after-tax cash-on-cash return. This is the land and building costs. This is how we're going to do depreciation. Closing costs. We're going to 8.75 million is the total cost. Allocated to land, the 2.1875 million. Depreciable basis is the total cost less allocation to land. Depreciable basis. The recovery period is 27.5, 5 years to own. Depreciation per year, 238,000. After 5 years, we will have an accumulated depreciation of 1.1, almost 1.2 million. So our adjusted basis, that's our total cost, our accumulated depreciation, our adjusted basis. And that is very important when it comes to selling it. Now, what we do here, like I said before, we're going to take that $990,000, which is our net income up here in year 6. And we want an 8% return on our investment. So we estimate the selling price. We take our $990,000 divided by 8%. We get $12.3 million. Broker's commission, we're estimating at $618,000. Other selling costs, total cost of sale, net selling price, $11 million. Now our mortgage at the end of the 5th year is still going to be $6.5 million. So we're going to have net proceeds of $5.2 million. We have to pay tax on the gain. Down here, we're going to calculate the tax on the sale. Our total tax, and we'll go into more detail on these things, is $1 million. Now our calculation of internal rate of return and net present value is here. Internal rate of return is 27.6, net present value 1.5 million. Now what does that mean? It really doesn't mean a whole heck of a lot on its own. Where the value of that comes in is comparing it to another property. If another property has a greater internal rate of return and a greater net present value, you have to consider the other property may be a better investment for you. But the numbers aren't the only thing to consider. There's plenty of other things to consider in buying real estate that we'll talk about. One of the big things is the neighborhood where you're buying, okay? Is it a good neighborhood or is it a bad neighborhood? Now typically what you want to do in rental real estate is, in investment real estate, is buy ideally in a transition period, a transition location, a location where property is going from bad to good. And we're going to go in more detail on that in future seminars. I wanted to keep this to 10 minutes. We're right at 10 minutes, so I'm going to close this down. Thank you.